Okay, good evening, students, and welcome to our taxation class. Okay, today we are going to go to one core area of your syllabus, which is taxation of business income, taxation of sole proprietorship, and taxation of companies. So we'll be looking at basis period of companies and businesses. When we say businesses, we mean any type of business, which is either company, sole proprietorship, or partnership. Okay, so we'll be talking about the basis period. Now, basis period is the fundamental in taxation. All taxes are based on a particular period. Okay, let me use an example. You know that NEPA bill is like a tax. Let's use NEPA bill like a tax. Of course, you must have consumed electricity. So those people who are using postpaid, you receive your bill. And as you receive your bill, let's say for the month of, they send you a bill in November. What bill will they be sending you? They will be sending you a bill for October 2020. You received it in November 2020. That means the bill you just received is based on your consumption of 2020, of October 2020. Now that means anything that you are being taxed is based on a particular period of operation. Now, what NEPA usually do is they do preceding month billing for those who are using postpaid. Even telecommunication, when you do a postpaid, normally it is preceding months billing. So that means if you're on postpaid MTN and you finished the month of October, you have to pay your bill in arrears. So it means when you are paying your bill is in November, but it relates to arrears. So the same thing with tax. Tax is taxed in arrears and not in advance, like all this prepaid meter, or like our recharge, our normal phone call, we do prepaid plan, and we are being charged before we utilize it. So we normally charge tax on arrears. So first of all, a normal basis period is a basis period that relates to arrears. There are three characteristics of a normal basis period. First, it must be in arrears, and we call that arrears preceding year basis. NEPA charge you in arrears the preceding month. It means if you are in November, they charge you bill for October. So the taxman is looking at your records. If you're in 2020, he's looking at 2019 record, which is the preceding year. So that is just 1 year in arrears. So that's the first characteristics. The second characteristics of a normal basis period is it must be 12 full months. How will you know in question that you are given a 12 full months account? Simple. Look at exercise 1.1. And let's go straight to where you see year ended. You see this word year ended. That is to show you it is 12 full months. But you see this period ended. Period ended is its signal to show you it's not exactly 12 months. It's either higher than 12 months, let's say 13, 14, 15, even 23 months, or it could be lower than 12 months. Let's say 1 month, 2 months, up to 11 months. So when you say period ended, you know you are dealing with less than 12 months. So now a normal basis period is exactly 12 months. So we've said two things now. One of them must be preceding year basis, and it must be the only account ending in the preceding year. Second, it must be 12 full months. And third, it must start the next day after the former accounting period. That means if an account ends if the former account ends in December 31st, the new basis period must start January 1. If an account ends in August 31st, please, sorry, somebody was just calling the line that is having the internet. I don't know. Okay, now I said that the tax law says your tax must be on preceding year basis, 12 full months that starts from where the other one stops. Okay, so whenever we see anything that doesn't behave in that manner, we know an abnormal situation has occurred. And there are three situations in which we can see abnormalities. Now, the three situations will form the bedrock of your basis period for today's class, which is, I call them the three C's: commencement of business, change of accounting dates, and cessation of business. So we are going to be talking about these three abnormal situations. And look out, I'll be telling you why they are not normal basis period. And I will tell you how you are going to deal with these abnormalities. Okay, let's look at commencement of business. To illustrate it, we'll look at exercise 1.1. Now, AYZ Company Limited commenced business on April 1, 2006, making up accounts to June 30 every year. The following results were extracted from the books of the company. And now you see the period here. Period ended June 30th, 27, June 30th, 28, and all that. We are told now that compute the assessable profits of the company for the relevant years of assessment in line with the rules of commencement of business and the alternative available to the taxpayer. So this question is loaded. This question has everything to do with commencement of business. So let's look at it. Now, whenever you commence your business, look at the things you're going to watch out for. First of all, look for the date the business commenced. Now, this is different from the date the business was incorporated. There are two different things. Let's say, for example, you went to incorporate your business with CAC, you submitted your form, and they now registered it, let's say on November 17, maybe today's date, but November 17, maybe 2019. Assuming that's 1 year ago, November 17, 2019. And you commence business January 1, 2020. The date you'll be looking at is not the date that is in your CAC certificate that you commenced, that you were registered. No, that date is just like your birthday. That date is just like the date on your birth certificates. That is not the date you're going to look at. The date you are going to look at is the date you commenced business. Perhaps like the day you start school. Okay? So in this case now, April 1 is very relevant because that's the date the business commenced. So later I will send this material to the classroom because I was so busy I could not send. Now, if you have the hard copy, you just underline commenced business on this date. Each time you see the word commenced business, you know you are doing commencement rule. Now, this April 1, you are going to use it 2 times. The first time you are going to use it is on the first year of business. The second time you are going to use it is on the second year of business. I will tell you how. Now you've identified the date the business commenced. The second thing to watch out is the dates they make up the account. Here we are told June 30th each year. Sometimes the examiner might tell you it's made up to June 30th each year. Then that means it's very lenient. Sometimes they will not tell you. And if they don't tell you, how do you know? Look at the account. Can you see that they are bringing it in June 30th every year? They brought one in June 30th, 27, another one in 28, another one in 29. That tells you this is the dates they make up their account. So you've seen, in case they didn't give you that, you know. Sometimes they might not give you these dates. How will you know the date the business commenced? If they told you this company commenced business in 2006, they didn't give you the date. The way they will state the account, they will not tell you period ended. They will give you the accounting period. They will tell you April 1 to June 30th. So once you see the first account, the first date signified the first account, the date the business started. So that's how you will know your business commencement date. Now, what do you do with commencement of business? You watch out for 3 years. 3 years are relevant here. So the first relevant year is the year the business commenced. How will you know the year the business commenced? Look at the date the business commence. The year is the first year you are looking for. So the business commenced April 126. That means 2006 is the first year in business. After knowing the first year in business, you need the second year in business, you need the third year in business. That means you need 2006, 2007, and 2008 accounts. So these are the relevant accounts that makes up commencement of business or commencement rule. How do you treat these three accounts? The normal way, which is the normal basis for commencement, is to treat them like this. The first year, okay, let's look at the solution. I will show you from the solution. The first year, you look at 2006. That's the first year. The first year is assessed based from the date the business commenced up to 31st December of that same year. We call it actual year basis. How will you know actual year basis? You look at the year of assessment, it is 2006. The first date in the period is also 2006. The last date in the period, all of them are on the same year. So if this period were 2005, you will call it preceding year. But all of them are in the same year with the year of assessment. We call that actual year basis, because the actual year they are assessing you to tax is the actual period they are looking at your record. Okay, so the first year is on actual year basis. Year basis end on 31st December of that same year. So I told you this date, April 1, is going to be used twice. So this is the first time you are using it. Let's forget about the workings for now. Let's look at the date because it's important for you to know this date. Now, April 1. Now, go to the second year of assessment. We say that's year 2, 2007. We are going to use this date 2 times. So this is the second time we are using it. We will now start from the date the business commenced, and you will count 12 full months. So if you count from April 1 to March 31st, that's 12 full months. You know, some people will be counting their fingers. April, May, June, July, August. What do you normally do? What will you normally do? You simply say, from April 1 to April 1, is it not 12? Yes. So, but you know that it will not be April 1 to April 1. All you need to do is, once you count April 126 to April 127, count 1 step backward. So look at what I normally do. If I'm standing in April 1, 2006, I know I will go to 2007. So there's no doubt about that. And I'll go 1 step back. I usually ask myself, what was yesterday's date? Yesterday's date would have been March 31st. So that's the 1 step back I'm going to count. So if I'm standing on April 1, I'll ask myself, what was yesterday's date? And so that means I'm going to end it at March 31st, 2007. That is how you do your 12 full months. Okay? Now, the third year, what is relevant is the date they are making up their account, 30th December. Okay? Now, it is the third year that you start doing what they call preceding year. Notice here that in this second year, 2007, you cannot say it's preceding, neither can you say it is pure actual. It is partially preceding because it started from the preceding year and it ended in an actual year. So it is partially preceding and partially actual. But the third year must be fully preceding. That is when the preceding year starts. So if you look at it now, what is most important is your ending date. In year 1 and year 2, your beginning date was the base, which you use in calculating. But in year 3, it is the ending date that will now be the major thing. So when you stand here, what do you want to achieve? You want to achieve this preceding year basis. So it means that if this is 2008, the ending date must be 2007. That shows this is preceding year. It must also be on the account ending date. So we have 30th June 2007, and it's going to be 12 full months. So what you do is you count 12 months back. So you can say June 2007 to June 2006. But of course, it cannot be June 2006. You have to count one step forward. So it's from July 1 to July 1 to 6 to June 30th to 7. What I normally do is, if I'm standing at the end date, I ask myself, because I'll count one step forward. So I'll just ask myself, what is tomorrow's date? If today is June 30th, tomorrow is July 1. So I'll just put July 1 here, then I'll put 2006, 1 year backward. Remember when we are doing year 2, we were standing at the beginning and we want to get the end. And say, instead of counting your fingers, you're standing at the beginning, you want to count exactly 12 months to the end. Ask yourself, what was yesterday's date? If you're standing at the end, so this formula of what was yesterday's date can be used only in year 2. Now in year 3, when you are standing at the ending, you ask yourself, what is tomorrow's date? So that you get the beginning. Now, what happens here is that in the normal basis period, there is what they call right of election. The right of election states that the taxpayer has the right to demand that the FIROS or the LIROS or any tax authority that has the authority to tax either the sole proprietor or the company, they have the right to ask them to assess the second year and the third year on actual year basis. Why will they have the right to do that? This is because the first year is already on actual year basis. And so that's okay for them. So they are now asking, if the first year is actual year basis, why don't you continue charging me second year actual year basis, third year actual year basis? Now, the only time they can ask that question is if they have checked and it will favor them to go by that. Then they can exercise their right of electing for actual year basis. That is why it is called right of election. But if they have checked and it is not favoring them, they will not exercise their rights. Notice here that it only affects year 2 and year 3. So whenever you are giving a commencement rule or commencement of business, and the question did not tell you to ignore right of election, then always do your right of election. How will you do it? So you see here, whatever you get in year 2 and year 3, you will sum them together. So you see, I have summed these two together and I have gotten a figure. Then I'm going to do another one, right of election. Forget about this year 1 I did here, it's just for illustration purpose. It's for year 2 and year 3. Then I'm going to sum them again. And now I'm comparing 3,120,000 with 2,880,000. So what happens? You as a taxpayer will know that the smaller figure will favor you. And so the smaller figure was as a result of the normal basis period. While if you try to exercise your right of election, you will run into trouble of getting a higher figure. So the advice is, do not exercise your right of election. Simple. Now I have showed us how to look at the basis period. How to look at the basis period. Let us now look at the workings. How do we work it out? So let's go back now. The question gave us a basis period. The question gave us, ouch. Look at the question now. The question gave us period ended June 30th, 27. Before we take that account, you ask yourself, what period to what period am I looking at? I am looking for April 1 to 6, any account that has April 1 to 6, and also up to June 31st to 6. Where can I find a period April 1 to 6? You simply find it here, because this period must have started on April 1. So here is from April 1. So it means you are taking this account. Now, this account must end in December 26. Now, does this account end there? No, it extends more than 26 to enter 27. So let's count it. From April 1, 2006 to December 2006. This period is a 9-month period. So from April to December is inside here, 9 months. Then we have from January to June 27 is 6 months. So 9 months plus 6 months means that this period is a 15-month period. And what do? We are taking 9 months out of it. So we come here and say 9 over 15 multiplied by that figure there. And it gives us 1,080,000. So this figure is representative of what your profit or your accessible profit is from April 1, 2006 to December 31st, 26. We'll go to year 2. We are still looking for April 1, 26 to March 31st, 27. And this account ends in June. And it's a 15-month period. And this April to March is a 12-month period. So we take 12 out of 15. And it gives us 1,440. Now the third one, we are starting our account from July 1, 26 to June 30th, 27. We can find our July 1 here, 26, and June 30th, 27 is what finally ends it. And you see, this is a 12-month period, and we are looking for 12 months out of that same 15-month period. So can you now see that the first 3 years, we take our figures from here. That's abnormal basis period. So you look at it now, we've have this 144,000. So when you add the second and the third year, we have this 2,880,000. Okay? Now, why is it abnormal basis period? Look at the first year. This April 1 did not start from where a previous account ended, because no account has started before. This is your very first account. So for that, there is no continuity. This is just beginning. So that's 4 shots. Second, it is based on actual year and not preceding year. And thirdly, this is a less than 12 months account. Look at the second year. The second year did not start where the first year ended. There's an overlap. And so that's the breach. It breached the normal basis period. Secondly, it is not on preceding year basis. There are some elements of actual year basis inside. Although it passed just one, it is 12 full months. Now let's look at the third year. The third year passes the 12 full months criteria. That's number one. Number two, it passes the preceding year basis criteria because it's the only account ending in the preceding year. This is 2008 and here is 27. Fine. But the only thing that it failed is that where March 31st stopped, this one did not continue from that. This one started from April. It started from July instead of from April. So you see, it failed to obey the last rule of normal basis period. However, from the fourth year, you see that the normal basis period will be followed without any problem. Let's look at the right of election. We said the right of election, we are considering only year 2 and year 3, so we ignore year 1 because this is a copy and paste of this year 1 of that other one. Look at year 2. We are saying that if you have assessed year 1 based on actual year basis, we are also going to assess year 2 on actual year basis. So you see here, actual year basis 2007, you can see it starts from January 1, 27 to December 31st, 27. And look at year 2 or year 3, which is 28, is also actual year basis, January 1, 28 to December 31st, 28. Now, look at year 2. You ask yourself, where can you find January 1, 27 account? Of course, this is June 30th, 27. It means January 1 can be found here. And so from January 1 to June 30th is how many months? That's 6 months. But you need something up to December 31st, 27. So if you cannot get up to December in 27, you move to the second account, which starts from July. And of course, you know that this is where your December 27 will be. Another 6 months. So what does that mean? What does that mean? It means that you are taking 6 months from here, so 6 months out of 15 months here, plus 6 months out of 12 months here. So that's what we did here. 6 months out of 15 plus 6 months out of 12 months. So when you tidy up their figures, it gives you 1,470,000. Okay? You now go to the year 3. You are looking for January 1 to 8 account. Where can you find it? Of course, you can find it in this second period, because from January 1 to June 30th to 8, that's 6 months. So we are taking 6 months out of 12 months here. Then the remainder of July to December is taken from here. Another 6 months out of 12. So 6 months out of 12 plus 6 months out of 12. That gives you 1,650. And of course, when you add the second and the third year together, it gives you this figure of 3,120,000, which when compared to 2,880,000, you now say you don't want to exercise your right of election. So you see, commencement rule, 3 years are relevant. The first 3 years in business. How will you know the first year in business? Watch out for the date the business commences. The year the business commences is the first year. The date the business commences is the date that will be used twice to begin the first year and the second year. The first year will be on actual year basis from the date. The second year will be from the date, and I usually say we want to count us yesterday's date. Now the third year is the third year is the preceding year basis ending on the company's choosing accounting date. Okay, people have been trying to call my line even when I'm in class, and it's affecting my network. Okay, so now we've done commencement of business. Let us now go to what we call the second C, which is the change of accounting date. Okay, now whenever you register your business with the CAC and you are filing your annual returns, now you would have, on the day you are registering your business, you would have, somebody's making a comment. Okay, thank you. Thank you, kindness. All right, now, when you are registering your business, you would have given the CAC the date in which you intend to commence business. And that's important. So that's when they will start expecting to tax you. Then every year when you are sending your annual returns, you will notify the CAC of the day you are making up your account. And so it means that your account ending date is important, because if you give them that, they will be expecting consistency. Now there comes a time when you will lose that consistency. You want to change your accounting date for administrative convenience. Now look at some of the reasons why you may want to change your accounting date. One of them is you are merging with another company to do business. That is merger. Let's say 2 banks merging together, or 2 big business merging together. So maybe your account date is September. You make your account ending September. The other one is making the account ending June. You might all decide that, okay, for the sake of convenience, let's just do everything to December. So both of you will change your account. It could be that another company is buying another company and it's a parent company. The other one is a subsidiary. And because the parent must produce a group account, and it will not be good if the parent is having a different accounting date, the subsidiary is having a different accounting date. So they might ask the subsidiary to change their accounting date to that of the parent. Or it could be a regulation from government that a certain industry will now need to change their accounting date to maybe December 31st. So for whatever reason, whenever you notice that you are no longer consistent in bringing your account, then that is signifying that a change of accounting date has started. So that period, that year of assessment when you first did a change, that is your first relevant year. You are going to identify 3 relevant years. So the first one is the first time you notice a change. In the case of exercise 1.2, the account, let's read it. Liadi Trading Company Limited decided to change its accounting year end from March 31st to December 31st of each year for administrative conveniences. Now, if you look at it now, look at this. This is another way of writing basis period. Instead of writing year ended, they might write or period ended. They might just give you the basis period. So if you look at this one full year, where did it end? This is 31st of March, in line with what they are telling you. But now look at this period. So when you see period, that's a red flag. Normally, the first time you should have seen period was in your first year in business. So you don't expect to see period ended anymore. So when you see it in the middle, just know that an account has changed its accounting date. So this is period ended because you want to change. You are no longer going to bring it in March 31st. You are now bringing it in December 31st. So this is what you first of all identify. This is when the change occurs. Which year of assessment did this change affect? That is your first year of relevant change, your first year of change. After you have gotten the first year, look for the second year, which is the next year, and the third year, which is the next year. So after getting these 3 years, you are going to do 2 things. The first one is you are going to pretend as if they never asked for change. Yes, true and fine, you have asked for change. But the tax authority will pretend as if you have not asked for change. They will continue to assess you based on the old dates, which is March 31st. So whenever you bring your accounts ending in December, they will adjust it in their own record and be looking at it from March 31st. Okay? After doing that, they are going to sum the 3 years in question. So they are going to sum them up, just like we did in right of election, where we sum 2 years. But this time we are summing 3 years. We are going to sum the first relevant year, second one, and the third one. We'll be looking at it. Let me show you the solution so that you best appreciate it. So it will be based, the first time is based on the old accounting date, which is March 31st. So you see the first relevant year is 2007. How did we know it is 2007? Look at it. They say its 2007 assessment was based on its account for the year April 125, which is this April 125, to March 31st, 26, to March 31st, 26. This is 12 months assessable profit. Now, if you look at it, how do we know? This is 2006. The account is ending in 2006. So we know that it is 2007 year of assessment. That is not our headache. That is not the problem. The problem starts with this period. This period starts the next day, April 126. But look at where it ends, 31st December 26. Which tax year is that? It must be 2007 tax year. It means 2007 tax year, you are charging tax 2 times. The first one was here when you did it well. And the second one was here when you are not supposed to have done that. So 2007, this basis period also affects 2007. So you will do 2007, this part 2. This is part 1, which he did well. Part 2, he didn't do this one well. This one was supposed to have extended to March to become 2008 year of assessment. But now you do this 2007 again. So that's your year 1. 2008 is year 2. 2009 is year 3. So if you look at it here, 2007, you pretend as if, so 2007, normally, we are doing it based on the old accounting year. So you see, you pretend as though they have not asked for change. March 31st, ending it. Mind you, they must be in preceding year basis. Everything you're doing here is preceding year basis. You go to 2008, and you continue as if they have not asked for change from April to March. Go to the third year, 2009. You pretend as if they never asked for change. April to March, preceding year basis. Then you sum the 3 years. So let's look at how we got them. The first one is this figure of 120, which was correctly done. No workings to it. The second one starts from April 1. Normally, you're supposed to end in March, but they ended in December, which is 9 months. So we are going to take this 9 months, 75,000, full 9 months. We need 3 more months, which means we need January, February, and March. So we are going to take 3 months out of 12. So we do here, this 75,000 is for March and for 9 months. Then we need 3 months out of 12 months. So we add it to 75, it gives us 135,000. Okay, now we go to the third year. The third year, we are still looking from April 1 to March. So we will get April 1 to 7 here, down to December is 9 months. So April to December is 9 months. So you are going to do 9 months out of 12 here. Then the remaining 3 months, you are going to take it here out of 12. So that's what we did here. 9 out of 12 plus 3 out of 12. And that gives me 187,000 when completely done. We sum the 3 years and we get 442,000. Okay? Now that is done. The second method is to base it on the new accounting date ending in December 31. Now the tax authority will say, okay, after doing it for that 3 years complete, old date, they will say, let us acknowledge your change. Let's go back and do all the things we were doing before in old date. Let's do it again in new date and see what will happen. Okay? Now, you know, the new date is December 31st. So that means it must start from January to December. And that's preceding year basis. So you ask yourself, where can I get 2006 January 1? You can get January 1, 2006 here. So you ask, from January to March, how many months is that? 3 months. So you're going to do 3 months out of 12 here. That means you need 9 months. Second 9 months is going to be from April down to December, which is this 9 months. So you are going to do 3 months out of 12 plus this 9 months. So that's what we got here. 3 months out of 12 plus this 75,000, which is 9 months. And that gives you 105. Now the second one is Second year, you start from January 1 to December 31st, 27. Of course, there will be no workings. This one is January 1 to December 31st, 27. Is this 240 you are going to bring? Then for the last year, it's still January 1 to December, you're going to bring this 28. So watch it, 240 and 28. So you add them up and it gives you 373. What do you choose? Okay, hold on. In commencement of business, you usually choose the smaller one because that is when the taxpayer has the right to elect. That is the only time the taxpayer can choose the smaller one. At all other times, the taxpayer must choose the higher one. So it means that the taxpayer will now go for this 3-year period in the old accounting date. Now, I want to let you know that in commencement rule, when you have done your right of election, assuming you finish the first and second and third year, and you compare your right of election, let's assume that it's the right of election that you choose. Do not continue the fourth year with right of election basis period. The fourth year will continue from the normal third year. Where the normal third year stops, that is where the fourth year will start. Now, coming to this change of accounting date, after choosing these 3 dates, can you say that is the old rule that is the old one that we choose, right? The fourth, the one after it, must continue from the new accounting date because they have changed their date. So you no longer follow this old date. Whether you choose this old one or this new one, doesn't matter. The next account must follow this because this is now that the 1st December is agreed to be the new date you are making up your account. So it must be following this new accounting date. Now we've talked about commencement rule, talked about change of accounting date, the second C, and we said the tax authority should pretend as though you have not asked for change. Continue using the old date for those 3 years. How will you get the first year? Look at when the change occurred. Which year of assessment did it affect? That was the first year. Identify the 2 next years after it. Treat them using the old accounting date, then go back and treat them using the new accounting date. Compare the sum of the 3 years in the old accounting date with the sum of the 3 years in the new accounting date and choose the higher one. Okay? Thereafter, you shall continue to base your account on the new choosing date. Let's go to the third C. The third C here is cessation of business. Cessation of business. Now, every business which you register as a partnership or a sole proprietor, normally even companies, you normally prepare your account based on going concern. It means that the account will continue in the foreseeable future. But that foreseeable future is for sole proprietor is as long as the owner is alive or the owner has not been declared bankrupt or insane, the business will continue. The same thing with the partnership business. If the partnership business has not come to the end of its terms or there is no death of a partner, the business will continue, or admission of a new partner. Or it could even be that government wants to ban that kind of business, so it ends. Look at a company. A company never dies. A company outlives its owners. because the shares can be passed on to people. But let's say the company is liquidating. The company cannot pay its obligation and it has to liquidate. It ceases trading permanently. Then the business is dying or has died. How will you account for it for tax? Look at exercise 1.3. Grace Limited has been in business for many years. As a result of the global economic meltdown, the business declined and Grace Limited ceased trading permanently on September 30th, 2009. Now, in cessation of business, you need to first identify the date the business ended. How will you know? They will tell you the date it ceased trading. If they didn't tell you, just go to the last of the account and pick the date there. That is the date the business ended. Now, there are two relevant years you should recognize when doing cessation rule. You need to know the year the business end. How will you know the year the business end? Look at the date the business end. 30th September. What year? 2009. So the year the business ends is 29. You need to know the year before the business end. The year before the business end is 28. So there are names we call them in tax. The year the business end, which is 29, is called the ultimate year. And the year before the business ends, 28, is called the penultimate year. So how do we treat the penultimate year and the ultimate year? Normally, we recognize the ultimate year first because it is when the business ends that you say, oh, this year is the ultimate year. You cannot say, oh, the year before must be the penultimate. So you may not know the penultimate until you have actually lived to see the ultimate. So when the business has ended, the law says, normally the penultimate must have been done in preceding year basis. The law says, when your business ends, go to your penultimate year and do it preceding year basis normally, which is what you must have normally done. Then go back again and do it based on actual year basis. So let me illustrate it here. Now, the year the business ends is the ultimate year, 2009. So that means that 2008 is the penultimate year. Normally, you would have done it based on preceding year basis, which is July 1 to June 30th to 7, preceding year. The law says go back again and do it based on actual year basis. Forgive me, this is 2018, not 2019. Perhaps I'll correct it before I send the material. This is 2018. So actual year basis. When you do that, look at the figures for the two of them and choose the bigger one. So you choose the bigger figure. You don't choose the smaller one, you choose the bigger figure. And that's for the penultimate year. You look for the preceding year basis, and you look for the actual year basis. Now look at the preceding year basis. It was given to us here, which is this figure. Which is this figure, because 2008 is the preceding year basis. So is the penultimate year, 2008. It will be based on this year of assessment. Preceding year basis will be July 1 to June 30th. So it will be this figure. That's what we have here. Then the actual year basis will be from January 1, 2008. So where can we get January 1? Here. up to December 31st. So here is December 31st. It cannot be found here. So from January to June is 6 months. So we are going to take 6 out of 12 here, which is what we did. Then the remaining 6 months, we are going to take it, that's from July to December. We are going to take it from here. That's exactly what we did. And we have this 331,500. And we choose the bigger one as being qualified to represent the profit, accessible profit for 27 or 28, the penultimate year. Then when you go to the ultimate year, which is the year the business ended, always do it on actual year basis. So that means we are going to say January 1, 29 to the date the business end. Actual year basis. How do we know it's actual year basis? This is 29, this is 29, and this is 29. Actual year basis. And so from January 1, 29, where can we find it? You can find January 1, 29 to June 30th, 6 months. So we're going to take 6 months here. And this remaining 3 months, which is 9 months, this remaining 3 months, this 19,000, we're just going to bring it. So we are taking 6 months out of 12 here, plus this 3 months figure of 19,000 gives me 151. So that's what we do for the cessation of business. So once again, cessation of business, we identify the ultimate year. That means the year before the ultimate year is the penultimate year. The penultimate year is treated in 2 ways. First is the penultimate, the preceding year basis. Then it will be treated again based on actual year basis. And so the preceding year and actual year for the penultimate year alone will be compared. Whichever is higher, that's where we will base our assessment. The ultimate year is always taxed on actual year basis, ending on the date the business is trading. Okay, now that's that. I now have this little exercise. I gave them in the Telegram group before, and people have not provided answers, both in your normal taxation class and advanced taxation class. I am yet to see people who provide answer. This question contains everything that I have told you about the 3 C's. So let's read it together and let's briefly explain how you can solve this. Now, CAN Limited, that's my abbreviation, CAN, that's me. CAN Limited commenced business on October 1, 2001. Now, can you see the key words I underlined? Commenced shows that I'm doing a commencement rule. This date, October 1, is important because I'm going to use it twice. Now, look at where I'm going to use it. I'm going to use it in the first year of business. I'm also going to use it in the second year of business. Let's read on. The company, however, chose 31st December as its accounting date. So this 31st December will feature from my 3rd year. So can you see my 3rd year? 31st December 2002. Fine. And subsequently, it's being featured, being featured, being featured. Okay? In the tax year 2006, this is relevant. In the tax year 2006, this is relevant. The company wrote to FIRS notifying the Revenue Service of its intention to change its accounting date to what? To May 31st. So you see, they have been bringing their accounts in December. That's the choosing accounting date. Now they are writing that they want to change to March to May 31st. So you see, that's a year of assessment and change of accounting date. And this 2006 is relevant. So from 2006, 2007, and 2008, you are going to be looking at old accounting dates, new accounting dates. Okay? Now, later in the year 2010, due to harsh economic recession, the company collapsed and folded. This year, 2010, is your cessation year. What date did it cease? We were not told. But if you look at the account, you will see that it is 31st October and 31st January 2010. So now that you have identified the cessation date and year, it means this year is the ultimate year. Go one step up below, one step backward. It means 2009 is your penultimate year. And how do you treat penultimate year? You treat it as preceding year basis and actual year basis. Now, something I should tell you again is this. After 2006, that they wrote to FRS to change their accounts, and we compare 26, 27, and 28 based on the old accounting date and the new accounting date. After doing that, when continuing to 2009, it will follow in line with the new accounting date. Now that's the whole question. See how small this question is? It contains everything you need to know about your basis period. Okay, so let's see how we can do requirements. Here they say required. Applying the rules of commencement, change of accounting date, and cessation of business, find the assessable profit for all 10 years. So I'll show you what to do here. Now, the first year is 2001. It starts from the date the business commenced down to 31st December of that same year. And if you look at the account, for some strange reason I don't understand, the accountants kept bringing up to October instead of December that it told the revenue service. It kept bringing up to October, and October. What do? You need to convert to December. So if your business started on what date? October 1. And here is period. It means this period must be October 1. And here is October 31st. That means this 18,000 is 1 month. So how many months do we need? October, November, December. We need 3 months. We have gotten 1 month. Where will we get the remaining 2 months? From this date, we'll get the remaining 2 months. And so here we'll say 2/12. So that's what we did here, 2/12. You add them up, gives you 35,500. The second year, we said, is 2002. It must start from the date the business commenced, and it must end 12 months later. I asked myself, if I'm standing at the beginning, I will need to know the ending date by asking myself, what was yesterday's date? If today is October 1, yesterday was September 30th. So this is September 30th, 2002. So because we started from the same date we started in the first one, so we are still taking this 18,000, which is 1 month. We need 11 months. So we are going to take 11 out of 12 of the second period. When we tidy them up, it gives me 114,250. Notice I kept it here and not here, because by keeping it here, I know I will be doing right of election. I want to see which one I will promote to the other side. So I put it here temporarily. Second year, I put the third year here also, and I'll sum. Then I will do right of election. I'll put it here. I'll put the second one here, and I will sum. So whichever gives me the lower one, it means these two are qualified. That is when I will now put this one here, and I'll put this one here. These ones did not make it, so it just showed them. Okay, we've done the second and the third year. Let's look at the right of election. We said the right of election is only affecting second year and third year. And we said if you have done the first year on actual year basis, do the second year and third year on actual year basis. So this is 2002. You must start from January 1, 22 to December 31st, 22. Where can we get that? January 1, 22 can be gotten here. So from January to October, that's going to be 10 months. So we're going to take 10 months here, and the remaining 2 months, we are going to take it here. So that's what we did. 10 months here out of 12, plus 2 months out of 12 in the other one. Look at 2003 account, see January to December 23. So you're going to look for where you get January to December 23. Of course, you're going to get January here. So from January 1 to October 31st, it's 10 months. So you're still taking 10 months here, and you're taking the remaining 2 months here. So that's what we do. 10 months, 2 months. Add them up, you have this. And you sum them up. I've told you how we did it, and we elected this figure. So it says here, do not exercise your right of election. Now, we've done year 1, year 2, year 3. Let's go to year 4. This is year 4. I told you from year 4, just ignore this right of election. You are going to continue from where year 3 stops. So look at it now. This is December 31st, 2002. The next date is January 1, 2, 3. That is date you use. Up to December 31st, 2, 3. So can you now see that you have continued now? Now the accountant's head has come down. It's continued bringing accounts. You are going to choose account that is from January 1 to December. So how do you do it? Where can we get January 1, 2, 3? January 1, 2, 3 can be gotten here. So from January to October is 12 months and 10 months. So you take 10 months here, then the remaining 2 months, you take it here. So that's what we did, 10 months here and 12 months here. Look at 2005. 2005 will start from January 1, 24 to December 31st, 24. Where can we find January 1, 24? We find January 1, 24 here. From January to October, that's 10 months. Then you need to find November, December, 2 months here. So, but we are seeing period. This period shows that there is going to be a change of accounting date. But we'll come to it. How many months is this period? This period must have started from November. So from November to March, to May. May from November to December is 2 months. January to May is 5 months. So 5 plus 2, 7. So this period is a 7 months period. And we are taking 2 months to complete our figure. So you see it here, 2 over 7. while we've taken 12 months here. Okay, now that we've done continuation now, a change of accounting date has occurred. Mind you, we said in 2006, they wrote that they want to change from December to May 31st. So you see, they have started bringing to May 31st. So you see, one thing, there is a period here and there is a change of date. Okay, so you ask yourself, which accounting year is this period affecting? Preceding year basis must end in 25. That means it's affecting 2006. So you see it here, 2006. So how many months is in this period? 7 months. But we're going to be doing based on the old accounting date. The old accounting date is in December. So you start from January 1, 25 to December 31st, 25. So that's what we are doing here. January 1. Sorry, old accounting dates. Old accounting dates is December. Sorry, here is it. Old accounting date is December, January 1, 25 to December 31st, 25. Okay, so where can we find our January 1, 25 account? You can find it here. So from January to May, it's 5 months. So we're going to take 5 months out of 7 here. Then we're going to take the remaining 7 months out of 12 here. That's exactly what we do. 5/7 here, then the remaining 7/12. Mind you, I'm putting my figures here because I'm going to be comparing with the new accounting date to choose the higher one. So I have this one here as my answer. Then I'll go for the next year, 2007. It's going to be January 1, 26 to December 31st, 26. Ask yourself, where can you find January 1, 26? You find it here. So from January 1, 26 to May 26 is 5 months. So I'm going to take 5 months out of 12 months here because this is year. So I'm taking 5 out of 12. The remaining 7, I'm going to take it here, 7 out of 12. So that's what I did. 5 out of 12 plus 7 out of 12. That's marvelous. The third year of change is 2008. So I'm going to look for 2007, January 1. I'm going to get it here. So from January 1 to 7 down to May is 5 months. I'm taking 5 here. Then the remaining June to December is 7 months. I'm going to take the remaining 7 months out of 12 here. So that's exactly what I did. 5 months out of 12, 7 months out of 12. Then you will now go back to do it based on the new accounting date. So the new accounting date will start again from 2006. They said they want to change to March, to May. So if it is 2006 year of assessment, what does that tell you? This is 2006 year of assessment. You know that it must be on preceding year basis. So it's going to end in 2005. And if they have changed to May 31st, so you are going to write May 31st, 2005. So if you are standing at the end of May 31st, 2005, you want to get the beginning, simply ask yourself, what is tomorrow's date? If today is May 31st, tomorrow's date is June 1. So I'm saying June 1, 2004. So that's the easiest way to look at it. So where can I get June 1, 2004? I will go to this 2004 account. I will get June 1 here. So from June to October is how many months? June, July, August, September, October. 5 months. So I'm going to take 5 months out of these 12 months. And that's what I did. 5 months out of these 12 months. Then I will need this remaining 7 months period. This period is exactly 7 months. So I know I need 12 months. So I'm taking 5 months here. I'm taking the remaining 7 here. So that gives me, prorated this on 5/12. I will bring the whole of 90,000. That's this year. Okay. Then the second year, I'm going to be looking at 2007. 2007. I'm going to be looking at 2006, January, June 1, 2005 to 31st May 2006. Good 18, they gave it to you year ending 31st May 2006. Take the whole figure without adjustment, and that's it here. The same thing with the next year, 2008, June 1, 2006 to 31st May 2007. They gave you the figure 31st May 2007. Take this 180, no adjustment, take it straight here. Now, when you sum these three with comparing the old and the new, find out that the new date has a higher result. That's why I am electing these ones to be here. Now, the continuation of the business must follow the new accounting date because you've changed from the old to new. Now, the new date, what is the next year? The next year, if this year is 2008, the next year is 2009. And we remember here that the business ended in 2010, and that's the ultimate year. It means 2009 is the penultimate year. So it means that cessation rule has started. 2009 is the penultimate year. We are going to use preceding year basis. By preceding year basis, we are doing it this way. Everything ending in this May 31st, 2008. It was given to us. Is this 108 here? And that's it here. But the law says you are going to compare it with the actual year basis. Actual year basis. January 1, 2009 to December 31st. So where can we find January 1, 2009? Just here. So from January to May is 5 months. We are taking this 5 months period out of 12. Where do we get the remaining 7 months? From here. So from June to December is 7 months. But here we are having from June to January the next year. So this is an 8 months period. So we are going to take 7 months out of 8. That's exactly what we did. 7 over 8. Here was 5 over 12. It gives me 110. And we choose the higher one, 110. Now your ultimate year is going to be on actual year basis. So January 1, 2010, to the date the business ended, 31st January 2010. So you look at it, you're going to find January 1, 2010 here, down to 31st January 2010. 1 month, but this is an 8 month figure. We are going to take 1 out of 8. 1 over 8 of 60,000. That gives 7,000. You put it straight down here. So you can see this one question has everything you need to know about your basis period. I want you to look closely at these questions, these 3 examples, and this one question, and see how you can come up with something that will help you to understand this topic. If you don't know your basis period, I tell you the truth, you are going to mess it up in exam. I may not attend any question now because I want to charge my system for the next class I'll be holding by 9. But I will ask you if you have any question, please send it to the WhatsApp group. I've not been seeing questions. I have questions sent to the WhatsApp group. By next class, my next class with you, you are going to be learning capital allowances. you are going to be learning capital allowances. And so if you don't know your basis period, capital allowance will be a problem for you. So let's learn this basis period between now, being Tuesday, and Thursday, when we'll be taking capital allowance. Until then, I want to tell you good night and have a wonderful day. And I expect questions in this topic, in this particular topic. There should be questions, especially in this last exercise I just did. If there is no question, it is understood that you have grasped the point, and I'll be very happy. Thank you so much once again. Look forward to seeing you in the next class. Okay, the material, yes, I'll send the material to the class little after I finish I'll send it today. Don't worry, I'll send it today. Thank you.